Okay, good evening, everybody. Thank you for taking the time to come and hear this webinar. We normally do our quarterly webinars in the first week of the new quarter, but next week is Pesach, and there's a lot going on. So we thought we would just do the webinar now and share our thoughts on what's happening on markets and on your portfolios. Speaking of what's going on, in the event of a siren, I will need to pause the webinar, and myself and everyone else in Israel on this call will have to go to the bomb shelter. And on the assumption that my office is still here afterwards, we'll come on and we'll carry on. I understand if you don't come back to the webinar, if such a disruption happens. I have had a siren in my live webinar in September 2024. It did happen, so it does break the momentum, so I do understand. So there will be a recording. We'll carry on afterwards if we do get that disruption. Okay, let's dive into how the market has done so far since the start of the war and the year to date to the 20th of March. That's Friday. Yesterday, the market had a very strong response to a comment by Trump that negotiations were going well. The S&P was up 1.2% on the day, which is a very strong number. And we need to take comfort from that. All right. The market is itching and waiting for a resolution. And when that resolution comes, please God, sooner rather than later, then the market will rebound just like it did yesterday. So we need to be in the market to enjoy those rebounds. The S&P 500 year to date to the end of March is minus 4.7%. And since the start of the war, minus 5.3. So most of that negativity is coming since the start of the war. I would say that that's a pretty benign result given what's happening. So again, that should be a source of comfort for investors. Even from a peak of late January, early February to now is only down minus 7%. A year ago, with the tariff drama from the peak of December through to the 9th of April, we were down 20% on the S&P. So a far bigger sell-off last year around tariffs than this year around the war. Again, take some comfort from that. NASDAQ year-to-date slightly worse than the S&P. You kind of expect that. However, since the start of the war, NASDAQ's actually a full point better than the S&P. The market's basically saying tech companies are less vulnerable, perhaps. MSCI World still better than the America year-to-date, minus 2.9 versus minus 4.7. But interestingly, since the start of the war, non-US has done worse. So if the MSCI World, which is about 60% USA, has done minus 7, then since the start of the war, non-US has done about minus 9, minus 8 to 9. So far worse. And that's kind of like there's an old saying that says when America sneezes, the rest of the world catches a cold. And the implication is that in any sort of crisis, you want to be more in the USA. So we're kind of seeing that happening, the dollar strengthening and the USA doing better than the rest of the world. Interestingly, one place to hide from the storm is right in the eye of the storm. Tel Aviv 125 is plus a remarkable 15.8% and plus 4% since the start of the war. The market actually opened on the Monday after the attack. Remember, Tel Aviv now trades Monday to Friday, not Sunday to Thursday. So it opened on the Monday morning plus 4%. It's been quite volatile since then, but it's a very strong story. And the shekel's been strong as well through the war. I'm going to talk about Israel separately later on in the presentation. MSCI China, China's broad index, done worse than the S&P year to date, but very similar since the start of the war. It's kind of a bit of a surprise to me. Now, when I said the response on the S&P is pretty benign at -4, when you look at the bond market, it's much more significant. Okay, remember the bond market, the numbers are always smaller, but the bond market is telling us, and the bond market is always more conservative than the equity market. Bond analysts are always more conservative than equity analysts, but the bond market is telling us something much more worrying than what the equity market is telling us. And the sell-off year to date is not much, but the sell-off since the start of the war, for treasuries to lose 3% in 3 weeks, or investment grade. Now, our expectation is that this is most of the bond damage that we'll see this year. Not all of it, but most of it. But it's basically telling us that the bond market is much more worried about the outcome. And this is coming from the inflation effect and the rising interest rates. Okay, Israeli bond market is doing fine, not as absolutely fine. And then another interesting number is gold. So year to date, gold is still positive at 4.9, so it's giving you some protection. A lot of volatility, but interestingly, since the start of the war, gold is down 13%. It went from 5,500 to 4,400. Now, I've often said that the short-term correlation between inflation expectations and gold price is broken and doesn't work. And this is a very good example of that. There is a correlation between inflation and gold over the very long term, but I'd much rather be invested in equities, which are going to do better than gold and more predictable than gold, than be in gold. And that's why we don't have a strategic allocation to gold in our portfolio. So in the short term, it's a bet, but the sell-off is something that people should take note of, because it really is against the consensus view on gold. Okay, I want to get my key messages across now in case there's a siren, so I've got your attention. Any market or economic view depends heavily on the length of the time the war goes on. Intuitively, we know the longer the war, the more severe the war, the greater the economic and market impact. Okay, but we don't know what that path's going to be, so it's very difficult to sort of trade on this basis. There's a lot of data which gives us long-term comfort. Okay, in the short term, a lot can happen. The disruption to the Strait of Hormuz is clearly significant, both economically and politically. I'm going to show you some data on that. Make no mistake, it's a very, very big deal in the world of gas and oil. Another interesting point, which doesn't really get much news in the international news, and that Trump has got problems at home. Okay, he's got big problems with Congress, and Congress controls the purse. Congress needs to approve the war finance. Right now, Congress is totally dysfunctional over funding for Department of Homeland Security, which includes immigration enforcement, and the SAVE Act, which is Trump's attempt to make sure that you produce an ID and only Americans can vote. And the Democrats are fighting both these things. So Congress is dysfunctional, and I think that this will force Trump's hand with respect to the war. If that forces an earlier resolution, but a weaker one, it's good for the market, good for the economy, not so good for Israel. But it is my base case that at a certain point, Israel and it might be fighting Iran on its own, but I hope that's not the case. Short-term spikes in oil are not something new. Okay, we've had them before. We had them in 2016. We had them during Corona under Biden. It's all about how long they remain elevated. It's not about the spike. Spike can happen and has happened in the past. The longer they remain elevated, the greater the second order and third order effects. For example, fertilizer and food. For example, sugar. You wouldn't think that sugar is directly linked to gas disruption in the Persian Gulf, but ethanol gas can be produced two ways, through the petrochemical way or the biological way. If the petrochemical way is not really working, then they'll move to the biological way. And how do you do that? You use sugarcane. So sugarcane gets taken out of sugar and into ethanol production, and therefore it affects sugar prices around the world. So you have all these second order and third order effects, which are not obvious. So we have a situation where there's concerns about economic growth. We're not expecting a recession. We are expecting lower global growth and lower US growth than we were thinking at the beginning of the year. And we are expecting higher inflation than we were at the beginning of the year. This combination of lower growth and higher inflation is not a positive outlook for investing. It's a little bit challenging, but just because we don't have conviction about being positive on the markets doesn't mean we must sell. What we do know as a fact is trying to sell and get out of the market and trying to time the market. We know that doesn't work. The best guys in the industry don't know how to do that right, because you have to get two decisions right. You have to sell before the fall, and you have to buy before the rise. And it almost never happens, right? You might get one decision right, but you're not going to get both decisions right. So it's much better to stay invested, ride out whatever volatility happens. And I'm going to show you some data about that. Okay, getting to the energy supply disruption. This is a nice chart I found from Goldman Sachs. I've got a few Goldman Sachs stuff here. I'd like to draw your attention to the red graph, the red bar. So we've got 7 major oil events here. 7 times the oil price has shot up. Okay, that's the blue column. The blue bar is the oil price shooting up. The red bar is the effect on supply. Okay, and visually you can see the left hand, the Iran 2026 war on the far left is far greater than the supply disruption from all these others, from Russia, Ukraine, from Iraq, Gulf War II, Gulf War I, and even the 1973 oil embargo. Okay, so we've got a very significant, and to put it very simply, we're experiencing the largest energy supply disruption in history, and there should be no doubt about that. Okay, having seen this, the spike in oil price, we're going to need to ask ourselves, what does the historical data tell us about the next 12 months? All right, so here's another chart from Goldman Sachs. It's a lot of information, but I'll try to summarize it for you. And this is what I said earlier, about the longer the price remains elevated over its average in the past, the worse effect on the S&P 500 12 months into the future. So 1 month, no effect on the 12-month S&P result. 2 months, no effect. 3 months, hardly an effect. 4 months, kind of flat. But 6 months and longer of elevated oil prices is going to be a problem. All right, it's going to be a problem. So, and that will, even if that minus 15% that you see on the right-hand side, if that happens, we'll be buying, not selling. Okay, because the recovery will come. We don't know how long, but the recovery will come, and we'll be buying. On the mitigating side of the problem, oil inventories were very, very high internationally. That's the yellow line here on the left-hand side compared to previous years. So countries have been building up their oil inventories significantly. So that buys us some time. So maybe referring back to the previous slide, maybe that whole analysis is pushed out a little bit because of high oil supplies. Then there's the whole Venezuela access. Now, in retrospect, we can see why the US did what they did with Venezuela, and the US now control Venezuela's oil industry. If you take US and Venezuela and you take OPEC minus Iran, they're pretty similar size in terms of their capacity. So that kind of, the US is kind of immune to on the supply issues. They still have to pay the higher oil price. And by the way, there's a big difference between West Texas oil price, Brent, which is used in Europe, and the Persian price, which is used there in the Middle East. And the other point is the oil contribution to the economy is lower than it's ever been. right? That's this right hand, and they call it oil intensity. Kind of makes sense that technology and things have reduced reliance on oil. So this kind of mitigates versus the historical data. Again, I'm trying to create long-term comfort here. Another graph by Goldman Sachs. They took the 7 most significant geopolitical events since 1950, and they averaged them 12 months forward, and the result was positive. On average, for all geopolitical events since the major geopolitical events since 1950, it's still worthwhile being invested. Drawdown happens. If you're the unluckiest guy and you invested in the S&P on the worst day before the Great Depression, or the worst day before World War II, or the worst day before the oil crisis of 73, et cetera, on this graph, as long as you remained invested, okay, the blue dot is how deep your drawdown was. Okay, and the brown line above is what your annual return would be had you stayed invested, even if you were the unluckiest guy. I know some clients who think that they're the unluckiest, but you need to remain invested in order to enjoy equity returns. You cannot outsmart the market. How's the Magnificent Seven done? Magnificent Seven, the names are on the left there. You pretty much know them. The red graph shows that they've done worse. And in a way, this is kind of a source of comfort, because the non-Magnificent Seven are only down 2%. That's good, given the circumstances. Okay. Are we giving up on the Magnificent Seven? Absolutely not. They are the strongest companies by far. They are huge contributors to the long-term growth of the S&P. So we still want them, and we still have them via our allocations. Valuations are high, but not a bubble. So the valuations have hardly changed since December. These are not irrational valuations. They are high. It's expensive. I think the point needs to be made that a trailing price earnings multiple of, say, 24 is in an environment of higher growth, higher prospects, less geopolitical, is more reliable than the same number in a lower growth, higher inflation environment. So one needs to be realistic about the expectations of the stock market, but we're still comfortable, and we're still allocating. This is the bond market that I said is pretty significant. I know the numbers don't look very large to you. So in January, the expectation of short-term dollar rates by the end of the year was around 3%, and now it's at 3.4%. So that difference may not look like a lot to you, but in the bond market, that is pretty significant. And there's even some people saying that we're going to see an increase in rates in Q4 of 2026. That we'll see closer to the time. This is a graph showing bond market volatility. The top line, this spike on the far right-hand side, is what led to the losses that we saw in the bond market since the start of the war. Okay, let me just summarize our sort of investment views. In December, and compare it to December, okay? December, we were cautiously optimistic about stocks and bonds. You know, the stocks, global growth looked positive, and we were looking to reduce the United States and to add developed market, non-USA. The valuations were high, but not a bubble, but we believe they were sustainable. Rates were heading down. The yield curve was going to be steeper, and inflation was sticky but under control, and the AI theme was a source of growth. That was our view in December. It's changed a little bit, okay? Not too much. Inflation's clearly heading higher, in our opinion. Short-term rates are not going to come down. They're either going to stay pretty much where they are and maybe at the end of the year come up. Global growth will be positive, but lower than what we expected. And valuations are more vulnerable, okay? Especially Israeli stocks, and I'll talk about that in a bit more detail later. The risk of sentiment and uncertainty mean that we're going to have volatility, just like we saw it yesterday and today. And the AI pressure So AI, the new version of AI came out, and there was a big sell-off in the software industry. I think this was overcooked. A lot of software providers are much stronger than the AI theme predicts, but it's definitely going to be a challenge for some of them. We still think AI is going to be a source of growth. I need to talk about private credit. There's going to be some news about private credit. Private credit is an asset class we use. You need to be a qualified client under Israeli law to buy it. And it's a great place to provide stability in the portfolio when your stock bond correlation is not working as it should. So it's very well managed. We like the big name funds, the famous names that you may or may not know: Apollo, KKR, Blue Owl, etc. These are decent firms, and I'm not at all concerned about the fundamentals of the asset class. I'm not concerned about the fundamentals of the asset class, but there is a mismatch. The mismatch is a liquidity mismatch. On the one side, you've got an illiquid asset class. Any private asset, whether it's private equity or private debt, this should be accessed by a 6, 8, 10-year fund that you could go in and you cannot get out. But what's developed over the last 10 years, which is a good thing for investors, is for a relatively low minimum, you can access this asset class and on a semi-liquid basis. So you can sell every quarter. Now, some of these funds are going to gate. In fact, many of them are going to gate because there's too much selling going on relative. Why? It's a long story, but I'm not concerned at all about the asset class. The gating is actually there to protect investors. If you want to discuss this in detail, I'll be happy to do that. I'm really confident in the asset class and the managers, by the way. All right, let's talk about Tel Aviv and Israel. As I said, Tel Aviv is plus 15.8%. That's the Tel Aviv 125, which can be thought of as the S&P 500 of Israel. At the bottom of this table is the Tel Aviv 35, which can be thought of as the Dow Jones of Israel. And the Tel Aviv 35 is plus 18.7. So which is above the Tel Aviv 125. So what that tells you is the larger companies, okay, which make up the Tel Aviv 35, have done better than the smaller companies, right? Banks have done 4.7. It doesn't look great on this chart, but 4.7 in a quarter is like 18% for the year on an annualized basis. So it's still a very, very strong number. Insurance has done very, very well. I believe this insurance sector is seriously overpriced now. Gas and energy up nicely. There's a lot of green companies in there. Technology's done very well. Lots of cyber security companies doing well there. Defense, Elbit is up 57% and is now the largest company, or the second largest, depending on what day, company in the Tel Aviv Stock Exchange. And you've got smaller companies like Aerodrome and Third Eye. Aerodrome is up 13-fold in 1 quarter, which is unbelievable. Property is a complex story. There's good property, and there's definitely some stress in the property sector there. I'll talk about that in a sec. Okay, some other comments which are interesting about Israel. So Palo Alto, a very large cybersecurity company listed in the US, bought a company in Israel and is dual listing in Tel Aviv. We normally see some Israeli companies like, for example, Teva, which is listed in Tel Aviv and abroad, but we haven't seen a company like Palo Alto dual list on Tel Aviv. So it's a very strong message to investors about Israel, particularly the size of the Palo Alto listing. Okay, Palo Alto is bigger than the next 3 largest companies combined. So the 3 currently, well, just before, it's actually, Palo Alto is actually listed, but the 3 largest companies are Elbit, Leumi, and Teva. You add the 3 together, you don't even get to Palo Alto. All right. So a very, very significant. Now, why is this important? Because all the index tracking products have to readjust. Okay. Now, in the index, they cap these large companies at 7%. So even if they're much bigger, it's capped at 7% to have some diversification, which is a good thing. But sometime in May, when all these index tracking products, of which there's a lot, are going to be selling 7% of other stuff and buying Palo Alto. So we're kind of watching that for around about the first week of May. There's a tremendous amount of money flowing from households. How do we know it's households? Because it's coming from mutual funds. And institutional buyers don't buy mutual funds. This is kind of the retail investor chasing last year's performance and being, many Israeli investors took money out of Israel 3 years ago, invested in dollars, and the Tel Aviv stock market has outperformed the S&P, and the shekel is incredibly strong. So they've missed out on massive amounts of performance, and they're bringing that money back and now buying the Tel Aviv, which has been pushing the market up and makes it a little bit vulnerable. Valuations are high, still cheaper than the S&P on a relative basis, but still high. And it needs to be said that Israel was trading very cheap relative to the S&P from about 2019 to early 2025. Bond spreads are tight. What that means, but not uninvestable type. We're still cautiously allocating there, only marginally tight. High-tech capital raising in Israel is still strong, so they're expecting $4 billion to be raised by the high-tech sector in Q1 2026, which is lower than your average quarter for 2025, but still higher than your average quarter for 2023 and 2024. So there's still good news, lots of money coming into Israel in Q2. And I think Israel's missile technology and defense is extremely well positioned going forward, but that's already reflected in some of the companies. The number of property deals closed, so that's all property, all types of property, is 9% lower in January 25 to January 26 to January 25. And the number of new apartment sales is 19% lower than January 25. So this is putting pressure on some of the big developers. Okay, so but the prices haven't moved much. Okay, in certain areas they've moved a little bit, but there's definitely some pressure there. And it's going to be a game of who can blink first, the developers or the buyers. So we'll see what happens there. How is the war financed? So we get this question occasionally. Israeli Treasury tried to raise 3 billion shekels in March 26, and they had subscriptions for 20 billion shekels. So there's no shortage of people looking to buy Israeli bonds and invest in Israeli government. The June 2025 war with Iran cost about 15 billion shekels. So a more intensive, longer war will cost more. It may reach 30 billion or more. Okay. But where is this reflected? This is reflected in debt to GDP. The government raises debt to finance the war. At the start of the 7th of October, we thought that Israel's debt to GDP would already be in the 70s. So it's a credit to the government that they've managed to keep it below 70, and it's currently at 69% debt to GDP. And we estimate, this is a rough estimate, that for each month that the war carries on, the debt to GDP will increase 2 to 3%. So 1 month of war, we go to 71 to 72, 2 months of war, 72 to 74. But these are still strong numbers, okay? This is not a number that is systemic. And just to put it in reference, after the first Lebanon war in the early 1980s, when the Israeli shekel had hyperinflation, the debt to GDP was 284%. So really 70 is nothing. The main risk to the Israeli growth story is high-tech industry, strong shekel. So the high-tech industry, some of the high-tech industry may suffer from AI developments. Other parts of the high-tech industry are going to benefit from AI developments, particularly cybersecurity. There's no doubt Israel is the capital of the world in cybersecurity. But the strong shekel may force international companies to invest less in Israel. So that's an issue. And inflation forecasts in Israel range depending on which analyst or bank you follow. from 1.8 to 2.8. We're actually a little bit more pessimistic. We're thinking slightly higher than 2.8, but it'll only be at the end of 2026 or possibly 2027. Just to show some graphics about Israel versus some other countries, the budget deficit spending, in theory should be zero, but it's not. So minus 5.4% is not great, but compares to France, Japan, India, and USA. And the forecast debt to GDP, this is for 2025 debt to GDP. So you can see Israel at 69, slightly weaker than Germany and South Korea, but stronger than India, China, UK, Canada, France, Israel, and of course, Japan. Growth forecast is interesting. In December, Bank of Israel said the growth forecast was 5-point-something%. It's now down to 4.8%. But compare that to all other major countries, South Korea, Italy, France, Japan, our prospects look pretty good here. Shekel rate expectation similar to dollar was expected to go down to the low threes. It's now 3.64 is the expectation of where the short-term shekel rate will be at the end of the year. And to summarize what I've said, we need to be realistic. There's going to be war-related volatility. We think the main driver will be how long the war lasts and how long oil prices remain high. We expect a Trump U-turn at some stage, and we'll be presented with a reality whether we like it or not, and that will cause a big rebound in the market. Inflation is heading up. In any sort of crisis, USA is still the best place to be with the deepest fundamentals. Recession probability is still low. Goldman Sachs estimated it for 25% by the end of 2026. I'd say slightly lower, but we're not expecting a recession. Short-term rates are heading down. And remember, it's time in the market, not timing of the market. Okay, so we got some questions in the registration process. To what extent should one diversify out of the shekel? And depending on the answer, so this is very client specific. Most of the people on this call, I'm willing to bet, English speakers associated with Israel are underinvested in shekel. If you're overinvested in shekel, say all your money is in shekel, then the first place you look is to the dollar. And this, 90%, if you live in Israel, 90% should be in either dollar or shekel. The 10% you can, if you're really interested in something, I don't believe in gold, I don't believe in Bitcoin. So if you're really looking for a bunker, then you go to the Swiss franc, but your returns there are very low. Interest rates are nothing. Your growth prospects on the Swiss stock exchange are nothing. You're going to have to pay some tax at source. So it's really not that appealing. I'd much rather, for an Israeli resident, I'd rather between the dollar and the shekel, that should cover your currency issues. Midterm effect on the markets. If you watch my December webinar or my September webinar, I showed a slide that basically it doesn't matter who's in the White House. The S&P doesn't really care, and we shouldn't look at markets through the political lens. Currencies and markets in Europe. Well, Europe is certainly more vulnerable than the USA to this energy shock. So is Asia more vulnerable than America. So, and we see this flight to quality concept with more and more money going, with the dollar strengthening during this crisis. So we expect that to happen. The European central banks have moved faster in increasing rates, trying to prevent inflation there, but I think the European chances of stagflation are much higher than the US chances of stagflation. Thoughts on gold and silver? I said it earlier. Short-term correlation with inflation broken. Long-term correlation exists, but I'd rather be in stocks because you make more money. This question, will Israeli high-tech and defense sectors be more resilient to the oil problem? Yes, I think I covered that. And the strength of the shekel versus the sterling and dollar in a time of war. Okay, so this goes back to the political lens. one should never look at currencies through the political lens. I've seen South Africans do it. I've seen Brits do it. Seen Americans do it. Everybody looks at Israel through the political lens and tries to predict currencies, and then they're surprised when the shekel is so strong. The shekel is strong for fundamental reasons. We export gas. We export weapons. Our pension industry is very large relative to our population because of compulsory saving. The pension managers allocate money to the S&P and they hedge that back. So they're buying shekels daily. The economy is strong. The debt to GDP is strong. Economic prospects are strong. So there's fundamental reasons why the shekel is strong, unrelated to political events. Okay, there's a question that came in about defense. What is the best way to access defense? We have a defense. Allocation in our portfolios, which we're very happy with, and we did a whole project on research about it. So it's a whole presentation on itself. There's different types of ETFs that access defense. Some of them have more of the Boeings in the world, and some of them have more of the technology stroke Palantir, cybersecurity, cyber defense. So there's different ways to play defense. We like to buy ETFs. So, we do have this allocation. It's quite a complex story. A lot of the good defense companies and a lot of the weapon manufacturers are owned by governments, so you can't access the entire sector so well. Okay, that's all. That's a wrap. Thank you very much. I'd like to take this opportunity to wish you all Chag Pesach Sameach V'Shaket. So a quiet Pesach for all of us. Thank you all for taking the time. Thank you.